All right, welcome to The Explainer. Today, we're taking a really fascinating macro to micro journey right through the global economic landscape of 2026. We're going to take these broad, high-level economic trends pulled straight from Goldman Sachs Asset Management's latest insights and transform them into actionable, highly specific portfolio adjustments for you. So if you've been wondering exactly how the absolute biggest forces in the world right now should be shaping your investments, well, you are in exactly the right place. Let's get right into it. But before we get too deep into the weeds, $3 to $4 trillion. Yeah, you heard that right. That is the massive projection from NVIDIA CEO for global AI infrastructure spending by the year 2030. It's almost hard to wrap your head around, isn't it? The sheer scale of that capital reallocation is literally reshaping economies as we speak. So the big question we have to answer today is this. As the market races into the fast lane, is your portfolio actually ready for a structural shift of this magnitude? Here's how we're going to break it all down today. First, we'll look at the macro tailwinds for 2026. Second, we'll cover AI as the present market force. Third, two paths forward, boom or disappointment. Fourth, we'll look at some solutions across emerging markets, rates, and infrastructure. And finally, number 5, the active ETF revolution. All right, starting us off, Section 1, Macro Tailwinds for 2026. Let's dive right in by establishing our baseline global economic outlook for 2026. Now, we're looking at a year of synchronized global growth, sure, but here's the catch. Central bank policies are completely out of step. It's like everyone's dancing to a different song. The US Fed, they're expected to just keep cutting rates, backed up by strong growth and fiscal impulses. The Bank of England is right there with them, cutting towards what looks like a 3% terminal rate. But then, look across the channel. The European Central Bank is likely on hold for an extended period, really needing a major catalyst to cut any further. And over in Japan, the Bank of Japan is actually tightening as their economy finally starts to wake up and reflate. So, what does this all mean for us? Well, it creates this highly complex, super fragmented monetary landscape that we need to navigate. Moving on to Section 2, AI, the present market force. This brings us to the single biggest fundamental force that is propping up all this global growth and, honestly, bridging the current economic soft patches: artificial intelligence. Listen, in 2026, we are no longer just talking about abstract software models or fun little chatbots, not at all. We are talking about a massive physical infrastructure built out. Billions upon billions of dollars are flowing into compute, thermal management, power generation, the real, tangible stuff. AI is a present physical force requiring physical things right now, and it is actively altering the entire economic landscape. To put that into perspective, in just the first half of 2025 alone, AI-related spending added almost a full percentage point to U.S. real GDP growth. I want you to think about that for a second. Without this heavy, concentrated capital expenditure, U.S. GDP would have pretty much flatlined amid a weaker labor market. It's literally holding things up. And guess what? It's only accelerating. Capital expenditures from massive tech hyperscalers are expected to reach a staggering $540 billion in 2026. This investment is basically the bridge carrying the U.S. economy over its current soft patches. Which leads us to Section 3, two paths, boom or disappointment. So we're really standing at a fork in the road when it comes to this massive upfront AI spend. The crucial point is determining whether all this money will actually translate into sustained economic output. On one hand, we have the upside scenario, a full-on productivity boom. In this world, AI boosts efficiency way faster than expected, and we enter a brand new era of rapid economic growth. Global tech and emerging market equities would absolutely surge, and inflation kept in check by pure efficiency. But on the other hand, we have the downside scenario, AI disappointment. Here, businesses start questioning the viability of these massive investments. Tech capex gets scaled way down, the U.S. economy slows significantly, and global equities face a sharp, painful correction. So you really have to ask yourself, which scenario are you positioned for?
Thank you for watching. Please like and subscribe to our channel.
Let's explore how to position ourselves in Section 4, Solutions, EMs, Rates, and Infrastructure. Knowing the big macro trends is really only half the battle, right? Knowing exactly where to deploy your capital is the rest. Now, when we think AI, we almost always default to US megacap tech. But actually, emerging markets are the hidden engine of the AI revolution. Get this, around 70% of global exports of semiconductors and AI hardware actually originate from emerging markets. They have the manufacturing depth and the deep supply chain dominance that the U.S. completely relies on to build out its AI infrastructure. This makes emerging market equities a structural, long-term play for your portfolio, rather than just a quick cyclical trade. Our second solution revolves around the fixed income market, specifically rates. Now, historically speaking, stronger productivity growth naturally coincides with firmer 10-year real yields. Why is that? Well, simply put, higher trend productivity makes capital more valuable. If AI actually delivers the huge productivity boost we're all expecting, it acts as a massive anchor pushing long-term real yields higher, particularly in places like the US and the UK. So, as an investor, you absolutely need to prepare for the structural shift towards higher long-term real rates over the coming decade. And that brings us to our third solution, infrastructure. You guys, the energy required to sustain this AI transition is just astronomical. By 2030, global data center electricity consumption is projected to reach 945 terawatt hours. To put that massive number into perspective, that is equivalent to the current electricity usage of the entire country of Japan. That is wild. Upgrading our aging grids and balancing traditional and renewable generation isn't just some nice-to-have environmental goal anymore. It is a critical, highly investable necessity for the modern digital economy. Finally, let's look at Section 5, the active ETF revolution. Because it turns out the how of investing is changing just as fast as the what. $2.1 trillion. That represents the record global ETF inflows we're seeing in 2025 alone. And look, this isn't just a brief cyclical spike. It signals a permanent, structural migration in investor behavior. It's being driven by a massive generational wealth transfer and an absolute, uncompromising demand for liquidity, flexibility, and transparency in portfolio construction. But to uncover the real innovation here, we need to look a little closer at those flows. Active ETFs, which, let's be honest, used to be considered a pretty niche product, now represents about 10% of total assets globally. But, and here's the kicker, they're capturing nearly a third of all new capital. The game just isn't about passive index tracking anymore. Investors are aggressively seeking active strategies within that super efficient ETF wrapper to find alpha, returns that actually beat the broader market, and to manage increasingly complex risks. And what's really fascinating is how this active ETF innovation is adapting so differently depending on the region. In the United States, the market is leaning heavily into derivative income ETFs, really focusing on alpha seeking and generating solid yield. Meanwhile, over in Europe, we're seeing this rapid adoption of buffer ETFs. These are funds that basically cap your potential gains in exchange for some serious built-in downside risk protection. It just proves that market architecture is evolving to meet highly complex, regionally specific investor objectives just as quickly as the tech sector itself is evolving. So that brings us to the ultimate question for 2026. With synchronized global growth, highly fragmented central bank policies, and an AI infrastructure build-out that is practically single-handedly holding up the U.S. economy, as the market races in the fast lane, are you positioned for the AI productivity boom, or are you bracing for the volatility of disappointment? I really hope this explainer has given you the structural insights you need to evaluate your own portfolio allocations. Keep learning, stay focused, and I'll catch you in the next one.
Thank you for watching. Please like and subscribe to our channel.